The integration of payback period analysis and legal risk assessment is essential for robust investment decision-making, contract structuring, and regulatory compliance, especially in high-stakes sectors like private equity, venture capital, infrastructure, and real estate. The payback period is a fundamental metric for evaluating how quickly an investment can recover its initial outlay, serving as a proxy for liquidity and short-term risk. Legal risk assessment, meanwhile, systematically identifies and quantifies potential legal, regulatory, and contractual exposures that could impact investment returns. When combined, these tools enable investors and legal professionals to adjust financial models for legal uncertainties, set appropriate contractual thresholds, and ensure compliance with regulatory standards. This integration is critical for managing risk, structuring enforceable agreements, and defending positions in legal disputes. Payback period. Simple. Time to recover investment from net cash inflows. Quick risk screen. Ignores time value and later returns. Discounted. Uses risk-adjusted cash flows. Preferred legally for accuracy and DCF alignment. Legal risk assessment. ISO 31000. Flexible. Principles-based. COSO ERM. Structured governance-focused. Best. Combine risk registers, scenarios, due diligence, and contracts. Integration in investment decisions. Risk-adjusted cash flows include legal risks, often lengthening payback periods. Scenario analysis tests legal event impacts, showing payback ranges. High legal risk may trigger shorter payback targets or higher hurdle rates. Payback period metrics are used in M&A and private equity contracts to trigger earnouts and milestone payments. Contracts must clearly specify whether simple or discounted payback is used, the discount rate, and include worked examples to avoid ambiguity and litigation. Regular reporting and audit rights ensure transparency and verifiability. Ambiguity in payback definitions or calculation methods can lead to disputes, with courts, e.g., Delaware, strictly interpreting contract terms and only considering external evidence if ambiguity exists. For effective use of payback period metrics in contracts, legal professionals must draft clear, detailed provisions, ensure robust audit/reporting rights, and follow regulatory and judicial best practices. This minimizes litigation risk and ensures enforceability in disputes, as CS has explicit terms. Regulatory requirements and professional standards. Regulators like the SEC and professional bodies, AICPA, CFA Institute, require transparent disclosure of payback period methods, especially in public offerings and regulated sectors. Some industries mandate disclosure of payback assumptions in filings. Best practice is to use payback period as a supplementary metric, not the sole basis for decisions, and always disclose its limitations. Payback period metrics play key roles in legal contexts. Breach of contract quantifies investment recovery time, helps assess foreseeability and mitigation, e.g., oil rig lost profits amid economic crisis. M&A transactions informs deal viability and required SEC disclosures. Inadequate controls can trigger SEC actions. Bankruptcy assesses reorganization feasibility and creditor risk, e.g., Lake River Corporation v. Carborundum Company. Regulatory hearings reviews compliance and risk disclosure, e.g., SEC alerts on fund deficiencies. Best practices integrate payback period and legal risk by clearly specifying payback method, simple/discounted, and calculation in contracts. Adjusting cash flows for legal risks and documenting assumptions. Using scenario/sensitivity analysis to model legal risk impacts. Disclosing methods and limitations in filings and investor reports. Regularly updating assessments and payback as legal info changes. Integrating legal risk into payback analysis is key. Private equity and venture capital shorten payback for litigation or IP risks, while infrastructure and real estate may extend payback for regulatory or zoning issues, using adjusted or discounted methods.